This is your Lead Left vodcast for the week of August 14th. I'm Randy Schwimmer. Welcome back. A recent Financial Times piece on bonds reminded us of their long, proud history, as well as their critical importance to the proper functioning of today's global markets. The article points out that while banks have faded in importance as holders of capital, bonds led by US Treasuries are major components of the world's financial system. At $133 trillion, the total bond market is smaller than the $181 trillion global banks represent. But as part of the shadow banking system, it's having an impact on how policymakers view regulation. Ironically, the failure of Silicon Valley Bank put a spotlight on the relationship between the bond market and the banking system. Fixed-rate instruments, even mortgage debt, in themselves aren't necessarily risky beyond their fundamentals. But in the context of a bank asset-liability mismatch amid rising rates where cash deposits are fleeting, they can be problematic. While Fed rate hikes have had a dampening effect on some aspects of the capital markets, particularly broadly syndicated loans and high-yield bonds, the corporate high-grade market has seen strong activity. As our chart of the week highlights, investment-grade bond issuance has had a better 2023 through July than the same period in 2022. This dynamic is driven in part by the attractiveness for buyers of investment-grade yields. The Fed's high-quality market bond yield is 5.2%. That compares to the 2% in early 2021. Further down the rating spectrum, single B bonds are trading at an average bid of 91 for a yield to worst of 8.5%. The discounted price reflects higher rates since March of 22, contributing to the poor performance of fixed income last year. Despite 2023 outflows of over $9 billion from retail funds, some measure of stability is returning to high-yield bond issuance. U.S. volume year-to-date is $103 billion versus $72 billion for the comparable 22 period. Compare that to the institutional leveraged loan market, whose activity level has shrunk from $178 billion year-to-date last year to $133 so far this year. Higher bond yields have been attractive for investors given how tight they were before the Fed's rate boost. But as our friends at Fundfire quoted one wealth management pro saying, "As nice as that trade is now, fixed income doesn't displace the power of private credit. If anything," he said, "they complement each other really nicely. You can still earn structural yields in the private credit market that take advantage of the illiquidity premium and some other structural inefficiencies, and I think both coexist in a big way." Reporting from the Bond Desk at the Lead Left, this is Randy Schwimmer, wishing you and your families a safe and healthy week.